Good evening, this is Tommy Lackey, and today is January 30th, 2014, and I thought it'd make sense if we did another quick breadth review to kind of see what this week has given us to work with. All of this is in conjunction with my larger report I put out each weekend, the Strength in Numbers report. If you'd like to take a look at it, email me to gtlackey@gmail.com, and if you have a StockTwits or Twitter handle, please add that in as well. After I get this video up and posted, I will also unlock last week's report so you can go through and kind of review it based on what I said then and what we were seeing then versus what we're seeing now. So let's jump in and take a look and kind of see where we are as of today's close. As always, we start here with our new high, new low differential chart. And we see that one of the concerns we had earlier this week was that the new lows in the beginning were working their way back towards positive, but expanded pretty bad yesterday. And that was kind of an issue on Wednesday, and so we were a little concerned about if we were going to see a good bit of follow through. But instead of that, which we suspected might happen, we saw the new highs turn back around as the market bounced off some short-term extremes. Now that's a good sign here short-term, but we have to see those keep expanding over the next days and weeks to make sure that this is something that is a good short-term low. As we'll see here in a few minutes, we certainly could see a failure here and one more leg down, or a bigger change in the characteristics of the market. But right now, as strong as this trend has been, we kind of have to honor and trust these signals that we're going to talk about here in just a few minutes. The new highs were 48 today, the new lows were 13, so good to see those new highs start to expand a little bit. Next, we hop down to our advanced decline line, and on the advanced decline line here, we see that we never did make a lower high. We're working our way back to pivoting back up here well above the trend line, and price is doing the same, so it looks okay here. Now we do still have a few warning signs out there, one of which is the McClellan summation index right here. It is still falling and has not turned yet at all. However, one good sign is it's above zero, so if we can get some more strength in the markets and get this to curl back up, it would be a nice sign for the markets. Now, one thing that is a very good sign here is that the McClellan oscillator did get down below the extreme levels, and not only did it do that, it formed a very short-term 2 to 3 day divergence right here, depending on how you count your days, and is now working its way back up. Again, we've seen that these extremes have been good signals, or at least darn close. But we also know, like I've said, that we could go back and see one more leg down that takes out these lows. But these are getting to extremes that look like if this larger trend is to remain intact, we're near a bottom, short-term bottom. Now, for those who follow me and read this last week's Strength in Numbers reports, you'll know that I talked about a prime setup for the MA breadth chart we have here, which is basically a setup to where the percent over the 200 SMA stays pretty well elevated, and as we can see, it stayed above this line since all the way back at the end of 2012. So that seems to be turning up, or trying to turn up here above that level. Then we have the 50, the percent above the 50 SMA, trying to turn up above the 40% level, which we've talked about is an area we like to look at. Again, you give or take a little bit. And then finally, we have down here the 20% above the 20 SMA. We'd prefer to come down and see it come down below this 20% level and turn up from above that. That would be a much more ideal signal. But as you can see on this chart going back, if you wait for the ideal signal, you didn't have very many entries over the last year and a half, and I think I'd be very disappointed if I was in that position. So we look for things that come as close as possible to our signal, and again, as strong as this trend is, I say we respect this until it proves us wrong. Now we move down to one of our other short-term breadth indicators, the breadth thrust indicator. And as we can see here, it's been a pretty good signal for us over the last year or more. If it's come down below this 0.4 level, which we had not only got it below there, we also got a very short-term divergence. So it looks like it is trying to turn up, and again, this isn't extreme enough for me based on the strength of the current trend until it proves us wrong. Does not mean we can't have one more shot down before we get, and one more extreme, but I would be comfortable starting to look at this and see if we could find some good opportunities. And finally, we end up with our percent day chart. One thing to note about the percent days, we did have our 90% down day at the end of last week. And so far this week, we've muddled around a little bit, and we look like we're trying to turn higher as you look at these in the candles right here. I've heard some people say that we need a 90, 80, or 90% up day to reverse this. I do not see that in a strong trend because, in fact, I go back through my chart where I have these marked, and it's not very often that we have gotten that over the last year, so I would not be waiting for that. So there's a quick review of the breadth and where we're at as of today's close. It looks to me like there's a good bit for us to work with here. We always have to be open for a failure in case something were to happen, but looks to me like I would be looking for opportunities. All right. I hope this helps, and have a great evening. Again, if you want to get the report, shoot me an email to gtlackey@gmail.com. Thanks, and we'll talk to you soon.